If you think the gold versus Bitcoin debate is about choosing the better asset, you're already setting yourself up to lose. In a real financial collapse, being right long-term is not enough. Assets don't fail because their ideas are wrong. They fail because they are used at the wrong moment. This is where most people misunderstand what actually survives, when the system itself comes under stress. Most people think financial collapses destroy wealth because markets go down. That's not true. Markets going down is just the visible part. Wealth is destroyed because people misunderstand what survives when the system itself is under stress. And right now, that misunderstanding is everywhere. As the conversation around the next collapse intensifies, the debate keeps circling around the same question. Gold or Bitcoin? Which one is better? Which one will win? Which one will make the most money? That question sounds smart. It sounds sophisticated. And it's exactly the wrong question to ask. Because when systems crack, assets don't compete on ideology or narrative. They compete on function, on timing, on how they behave under pressure, not in theory, but in reality. Before we go further, quick note. If you appreciate analysis that focuses on understanding systems rather than picking sides or chasing narratives, consider liking the video and subscribing. This channel is about clarity, not hype. And I'd really like your opinion on this. Do you think gold and Bitcoin are competing assets? Or do they serve fundamentally different roles that most people mix up? Let me know in the comments. A lot of future videos are shaped by these discussions. This is not a video about price predictions. It's not about hype. It's not about choosing sides. It's about understanding how different assets behave when liquidity disappears, trust erodes, and policy starts improvising. And to do that honestly, we have to start with something most people ignore: timing and history. Bitcoin feels old to a lot of people now, but in financial terms, it is extremely young. Bitcoin came into existence in January 2009, right after the global financial crisis had already broken the system. It did not exist during the dot-com crash. It did not exist during the 2008 banking collapse. There is no Bitcoin data from those periods, no matter how confident some narratives sound. That matters, because it means Bitcoin has never been tested in a full, multi-year, debt-driven global collapse of the traditional financial system. Not yet. What Bitcoin has experienced instead are a series of macro stress events that still matter, but are structurally different. The first was the European sovereign debt crisis between roughly 2010 and 2012. Governments were under pressure, banks were exposed, and the euro itself was questioned. Bitcoin was still small, illiquid, and largely ignored by institutions. Its price moved, but mostly in response to internal adoption cycles rather than macro flows. Then came March 2020, which is the most important stress test Bitcoin has faced so far. Not because it was long, but because it was violent. In a matter of days, global markets experienced a liquidity shock unlike anything seen before. Everything that could be sold was sold. Stocks, bonds, commodities, and yes, Bitcoin. Bitcoin did not behave like a safe haven in that moment. It behaved like a high beta risk asset. It dropped sharply alongside equities as investors rushed for dollars and liquidity. This is not an opinion. It is observable market behavior. That doesn't make Bitcoin useless, but it tells us something critical about its role in a panic. After that, Bitcoin experienced the 2022 rate and inflation shock. Central banks aggressively tightened policy. Liquidity was withdrawn. Risk assets globally repriced lower. Bitcoin again moved in the same direction as speculative assets, experiencing deep drawdowns. Then, in 2023, during the US banking stress around Silicon Valley Bank and others, Bitcoin rallied briefly as a narrative hedge against banking instability. But even there, the move was driven more by positioning and sentiment than by a wholesale shift of capital out of the traditional system. So when people say Bitcoin has been through crises, the accurate statement is this: Bitcoin has been through macro stress events, but always as a young, volatile, adoption-driven asset inside a still functioning system. That distinction is everything. Now let's talk about what Bitcoin actually is when stress hits. Bitcoin is a non-sovereign digital monetary network. Its core strengths are clear. It has a transparent monetary policy. It is not directly controlled by any single government. It can be moved across borders without physical transport. And in a world where trust in institutions is declining, those features matter. But Bitcoin also has structural weaknesses that only show up under pressure. In practice, most Bitcoin is not held in cold wallets. It is held through exchanges, custodians, ETFs, and regulated intermediaries. That reintroduces counterparty risk, regulatory risk, and seizure risk. And yes, crypto has already been confiscated, assets have been seized, wallets have been frozen, access has been restricted through legal and regulatory action, including under US administrations. The idea that crypto is immune to state power is not supported by real-world evidence. More importantly, Bitcoin depends on infrastructure, electricity, internet, legal access to on-ramps and off-ramps. In normal times, that's fine. In systemic stress, dependencies matter. This is the core distinction most people miss. Theoretical censorship resistance is not the same as practical accessibility during a crisis. Bitcoin may be hard to shut down completely, but it can be made very hard to use, very hard to convert, and very volatile in the process. Now, contrast that with gold. Gold is not a network. It is not a protocol. It is not an idea. It is a physical monetary asset with no counterparty risk. You don't need permission to own it. You don't need a functioning payment system for it to exist. Gold has been part of every monetary regime humanity has ever built, and it has outlived all of them. That doesn't mean gold is perfect. It can be confiscated. It has been restricted in the past. It has storage costs. It can be sold during liquidity panics. All of that is true. But gold behaves differently under stress, and history makes that very clear. In every major crisis, gold tends to follow a similar pattern. When panic first hits and liquidity disappears, gold can fall as investors sell what they can to raise cash. That is not a failure of gold. It is a reflection of gold's liquidity. The difference is what happens next. Gold tends to stabilize faster than most assets. It tends to recover its pre-crisis level while uncertainty is still present, and it often reaches new highs before the crisis is even resolved. Why? Because gold is not pricing growth. It is pricing distrust. As trust in currencies, institutions, and policy erodes, gold becomes attractive not because it promises returns, but because it promises survival without dependence. This is why central banks hold gold, not for yield, not for speculation, but because in moments where systems are questioned, gold does not require belief. And this brings us to the most uncomfortable but necessary part of the conversation. State power. Both gold and Bitcoin can be targeted. Anyone telling you otherwise is selling a story, not reality. Gold can be physically confiscated, but it is hard to monitor at scale. Bitcoin is easy to monitor, but harder to physically seize if self-custodied correctly. In practice, most people do not self-custody correctly. The state does not need to eliminate an asset to neutralize it. It only needs to control access, liquidity, and legal usage. That is true for gold. And it is true for Bitcoin. The difference is how each asset responds to that pressure. Gold has survived confiscation regimes before. Bitcoin has not yet faced a full-scale, multi-year, systemic crackdown under collapse conditions. That does not mean it won't survive. It means we do not yet know. And when you're thinking about wealth preservation, uncertainty matters. This is why comparing gold and Bitcoin as if they are interchangeable is a category error. They do not solve the same problem at the same moment. Up to this point, we've established something critical. Bitcoin is a powerful innovation with upside potential, but it behaves like a risk asset under liquidity stress and depends on infrastructure and regulation in practice. Gold is a blunt, imperfect, but deeply resilient monetary asset that has proven its role across centuries and crises. What matters next, and what we will address in the next part, is how these differences play out once the system moves from stress to fracture. Because the real question is not which asset you believe in, it's which one you can rely on when belief itself becomes fragile. Now that we've established what gold and Bitcoin actually are under stress, the real comparison can finally begin. Not in theory, not in ideology, but in how a systemic collapse actually unfolds, phase by phase, because collapses don't happen all at once. They move in stages, and assets don't behave the same way in each stage. The first phase of any real collapse is not about ideology, innovation, or long-term visions. It's about liquidity. Panic sets in, leverage unwinds, and the only thing the system cares about is cash. Not profit, not growth, cash. In this phase, almost everything is sold. History is very clear here. In March 2020, when markets froze, Bitcoin did not act as a hedge. It dropped hard, alongside equities and other high-risk assets. That wasn't because Bitcoin failed its philosophy. It was because markets were not evaluating philosophy. They were evaluating liquidity. Bitcoin, in that moment, behaved like what it practically is today. A high beta, speculative asset with limited institutional depth compared to traditional safe havens. When margin calls hit, Bitcoin was sold. Gold, on the other hand, also sold off, but not in the same way. Gold declined, but far less. More importantly, gold found a bottom quickly. That tells you something fundamental. Gold is liquid, but it is not fragile. This is the first decisive separation. In a liquidity panic, Bitcoin amplifies the move. Gold absorbs it. This alone already answers an uncomfortable question most people don't want to face. If the collapse begins tomorrow, Bitcoin is far more likely to increase stress in a portfolio than reduce it. Gold does the opposite, but collapses don't stop there. Once the initial panic passes, the system enters a second phase, trust erosion. This is when people stop asking, how do I survive the week? And start asking, what do I trust at all? This is where narratives start to matter again. In this phase, Bitcoin often finds its strongest arguments. distrust in banks, distrust in governments, distrust in fiat currencies. All of that feeds directly into Bitcoin's story. And this is why, after initial crashes, Bitcoin can rally violently. But here's the problem. Narratives don't override structure. Even in trust erosion phases, Bitcoin remains volatile. It can move up fast, but it can also reverse just as fast. Because it is still priced by marginal buyers and sellers, many of whom are speculative, leveraged, or momentum-driven. Gold behaves very differently here. Gold does not need a narrative. It doesn't need belief in a new system. It benefits simply from the absence of trust. As bonds become questionable, as cash loses purchasing power, as equities remain volatile, gold quietly attracts capital that wants to wait without making a bet. This is why, historically, gold often recovers to its pre-crisis level while the crisis is still unresolved. It doesn't require optimism. It requires uncertainty. Now comes the third phase, and this is where the debate often becomes ideological instead of analytical. The third phase is policy response and regime shift. Governments intervene, central banks improvise, rules change, liquidity is injected, withdrawn, redirected. This is where systems are reshaped, not fixed. Bitcoin can benefit enormously in this phase, but only under certain conditions. If the response undermines confidence in fiat systems without aggressively restricting crypto infrastructure, Bitcoin's upside optionality is real. That's the asymmetric bet many people are attracted to. But that upside comes with conditions. Bitcoin's performance here depends on regulation, access, and continued network usability. It is not unconditional. Gold's performance in this phase is different. Gold benefits regardless of policy ideology. Inflationary response, deflationary response, monetary expansion, currency debasement. Gold does not need the policy to be right. It benefits from the fact that policy is reactive. This is why gold has historically moved higher even as policymakers claimed stability. At this point, the core distinction becomes impossible to ignore. Bitcoin is an asset of optionality. It can deliver extraordinary gains if the system re-architects in a way that favors it. Gold is an asset of inevitability. It does not care how the system re-architects. It only cares that the system is under question. This brings us to the mistake that destroys most investors during collapses. They treat Bitcoin as if it were gold. They expect it to protect capital in the first phase. It doesn't. They expect it to be stable during panic. It isn't. They expect it to behave like insurance. It can't. Bitcoin is not insurance. Bitcoin is a leveraged bet on a future regime. Gold, on the other hand, is not a growth asset. It is not meant to outperform everything. It is meant to preserve optionality so you can still play the game after the shock. This is why asking which one is better is the wrong framing. The correct framing is this: which one do you need first? If your priority is survival, liquidity, and control during a collapse, gold reigns supreme. It has the longest track record, the shallowest drawdowns and panic phases, and the least dependence on infrastructure or belief. If your priority is upside participation in a post-collapse regime shift, Bitcoin can be powerful. But only after the system has already cracked, and only as a calculated allocation, not a substitute for protection. And this leads to the final reframe. Gold and Bitcoin are not enemies. They are not replacements. They are tools designed for different moments in the same cycle. Gold dominates the collapse. Bitcoin competes in the aftermath. The investors who lose everything are the ones who ignore sequence. The investors who come out stronger are the ones who understand that survival comes before opportunity. This is not about fear, it's about clarity. When the system is stable, you can afford to chase narratives. When the system breaks, you need assets that don't require belief. Gold doesn't ask you to believe. Bitcoin asks you to believe and to be right about timing. In a coming collapse, that difference is everything. And if you understand that now, before panic makes decisions for you, you're already ahead of most of the market. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.